Welcome to The Explainer. Today, we're diving into something pretty surprising, a sudden stabilization in the global diamond market. Now, if you've been watching the commodity sectors, raw materials, or the luxury goods space at all lately, you know the diamond industry has been on a total roller coaster ride these past couple of years. We're talking massive supply gluts, shifting geopolitical barriers, and absolutely plunging valuations. But some brand new data suggests the tides are actually shifting, and it looks like the market is finally finding its floor.
13. Okay, I'm starting with this number right out of the gate because it's literally the key to everything we're looking at today. That number represents a grueling 13 consecutive months of price declines that the global diamond industry just dragged itself through. It has been a long, painful slide for suppliers, miners, and traders. A lot of these folks have been fighting just to keep their heads above water while inventory piled up. But as of July 2026, the market has finally snapped that downward streak.
All right, let's dive into our roadmap for today. We're going to break this down into 5 parts: breaking the negative streak, anatomy of a diamond slump, the De Beers dilemma, the new tariff regime, and finally, luxurious retail shines bright. Okay, kicking things off with Section 1, breaking the negative streak, looking directly at the July 2026 market data. So, taking a look at the Rapaport Trade Diamond Index, or the RAPI, check out that July 2026 column. You'll notice that all 4 major diamond categories posted flat or positive figures. Guys, this is the very first time this has happened in a single month since way back in March 2025. I really want to point out that 1 carat row, a totally flat 0.0% change. Now, I know flat might not sound super explosive, but in a market that has done absolutely nothing but fall for over a year, flat is incredible news. The 1 carat diamond is the benchmark. It's the psychological anchor for the whole industry. Hitting a 0% change there tells traders that the freefall has finally found a solid floor. And right above it, you'll see a solid 1.8% increase for half-carat stones. That marks its absolute best month in over a year. When you chart this data out visually, you can literally see the relief washing over the market. Notice those top 2 lines tracking the smaller stones, the 0.30 and 0.50 carats? They are dynamically pushing upward. This upward correction in smalls is being actively driven by a tightening of lower global production. Now contrast that momentum with the red line at the bottom, which represents the massive 3-carat stones. That category basically just maintained its stability, holding firm with a slight 0.2% uplift by the end of the month. So the smalls are correcting upwards, while the heavyweights are standing strong. So, you might be wondering, why exactly are those bigger stones remaining so incredibly steady, while the smaller stones fluctuate? Well, it all comes down to highly specific, targeted consumer interest rate here in the U.S. market. The data shows U.S. buyers are actively zeroing in on 2-carat diamonds in the G to J color range with clarities between VS1 and SI2. And to get even more specific, they want round cuts and long fancies. This isn't just random chance. This represents the absolute core of the American bridal and premium anniversary market. This targeted, persistent consumer behavior is providing a massive, solid anchor for the larger stone categories, while the rest of the market tries to find its footing. Moving right along to Section 2, anatomy of a diamond slump, or what was essentially a perfect storm. So the market was actually improving in the first quarter of last year, but then a true perfect storm hit. It was a compounding series of issues. First, India engaged in a mass import of rough diamonds. This immediately created a huge oversupply right at the exact moment the U.S. dropped new tariffs on the industry in April 2025. And while the acute shock of those duties eventually eased up, the market just kept getting pummeled by secondary waves. We're talking heavy competition from lab-grown synthetic diamonds eating up market share, stubbornly weak demand from a sluggish Chinese economy, and a sudden, completely unexpected flood of rough diamonds coming out of Angola. Put all that together, and it completely derailed the market's early 2025 improvements, depressing prices across the board for the next 13 months.
Which brings us to Section 3, the De Beers dilemma and the corporate ripple effects.
Now, what's really interesting about this is the sheer scale of the value destruction we've witnessed. It's staggering. De Beers is quite literally synonymous with diamonds. Historically, they've controlled the global market with an iron grip. Yet this persistent slump has deeply impacted corporate sentiment. Anglo American, the parent company, is reportedly considering an offer of just $1 billion for its 85% stake in De Beers. For a company of this legacy and historical dominance, $1 billion is remarkably low compared to past valuations. It's a stark reminder of just how heavily a 13-month price decline weighs on even the most legendary corporate asset values. So how do you survive a trough like that? You take drastic measures. De Beers is undertaking a multi-step corporate restructuring.
Step 1, they are entirely suspending production at their Venetia mine for 2 whole years. Let the gravity of that sink in for a second. They are shutting down a major operational mine for 24 months just to choke off the supply. Step 2, they're using this operational pause to deeply streamline the company's corporate structure and cut overhead. And step 3, as we saw in that July data, they are capitalizing on these newly stabilizing rough prices. This aggressive strategy is actually working, as De Beers successfully narrowed its first half losses recently. They are literally halting their own production to let the global market heal.
All right, Section 4, the new tariff regime and shifting trade rules. Here is the new playing field that just went into effect this summer. On one side, you have the tariff hit. The U.S. is maintaining a strict 10% duty on diamonds that are polished in India. But look at the exemptions. Diamonds that originate from Belgium, Botswana, and Namibia are receiving distinct exemptions from this duty. The real-world economic impact here is immense. It hands these specific geographic locations an immediate structural cost advantage, especially when we're talking about trading high-value goods. It basically redraws the map of where it's most profitable to source and polish diamonds for the American market. But how are the regions actually reacting to these new rules on the ground? It's a fascinating contrast, really. Despite that heavy 10% tariff hit on Indian polished goods, the mood in India has actually firmed up. Domestic activity there picked up considerable momentum ahead of major local events like the IIJS show and the Diwali season, which proves their internal market remains incredibly robust. Over in the U.S., despite implementing the tariffs and changing the whole import landscape, the market simply absorbed the changes and remained entirely stable throughout the summer. It really highlights a global trade network that is incredibly resilient, actively adjusting to geopolitical friction and successfully finding a new equilibrium. And finally, let's hit Section 5, luxury retail shines bright, or what I like to call the consumer disconnect. Because here's the crazy part. While the upstream supply chain was battling oversupply, mine closures, and 13 months of brutal price drops, the downstream luxury retailers were completely defying gravity. Kering reported a massive jump in second quarter jewelry revenue, specifically led by their major houses Boucheron and Pomellato. Meanwhile, LVMH, the absolute giant conglomerate that owns Tiffany and Bulgari, they also reported a notable increase in watch and jewelry sales for the first half of the year. So the raw materials and the miners might be struggling, but the finished, polished luxury products sitting in illuminated glass cases, they are selling incredibly well. And what exactly is fueling this massive disconnect? Well, both Kering and LVMH explicitly noted that the retail growth is being driven by unexpectedly positive demand from both the US and Asian consumer markets. So why does all of this data matter to us? Because it proves that regardless of shifting tariffs, drastic mine closures, or rough diamond gluts, the fundamental human desire for luxury goods remains rock solid. It's this persistent end consumer demand that's ultimately keeping the entire upstream industry afloat. It acted as a lifeline, allowing the market the critical time it needed to finally stabilize in July. Which leaves us with a really fascinating dynamic as we look ahead. We've just seen De Beers basically throttle production by closing mines, effectively tightening the rough supply right at the source. But at the exact same time, we're seeing major luxury brands report rising consumer demand at the register. If supply is shrinking at the mine, but demand is growing at the mall, I leave you with this final thought to chew on. Who actually controls the pricing power as we move into 2027? Is it the miners digging the stones, the policymakers writing the tariffs, or the luxury brands selling the dream? Thank you so much for joining me for this explainer, and keep your eyes on the data.